Welcome. This is the mini lecture for Chapter 12, the second chapter on the ISLM model. Let's get to it. All right, we've now developed a basic understanding of the ISLM model. And so now we can use it to try to explain the behavior of the economy in the short run, that is, the business cycle. Now, output can vary in the ISLM model whenever exogenous shocks to the economy cause shifts in either the IS or the LM curve. Here as a reminder, the IS curve here, and you cannot see my cursor. One moment, please. Arrow options visible. Nope, I don't think you can see it. Here we go. All right. The IS curve here shows all the combinations of output and interest rate that allow the goods market to be in equilibrium. The LM curve shows all the combinations of output and interest rate that allow the money market, liquidity money, to be in equilibrium. The market for cash. LM, liquidity money. IS, investment savings. We usually shorten it to the money market and the goods market. So this intersection, that's the one combination of output and interest rate that allows both these markets to be in equilibrium. And we can use this model to examine the effects of changes in policy, fiscal policy, monetary policy. Okay, suppose we start in equilibrium here, and government spending increases by, see if I can do this, delta G. And where is it? There we go, delta G. That shifts the IS curve right. This increase in government spending, well, that spending becomes other people's income. And that also increases spending, and so on and so forth. The total effect for an increase in spending of delta G is delta G times 1 over 1 minus the marginal propensity to consume, or the change in government spending times, this is called the fiscal multiplier. So if government spending goes up by this amount, then the IS curve shifts right by this whole amount, or we see is marked as 1 here. Now, if we only had to worry about the goods market, that would be the end of the story, and the economy would have grown by that amount. But the increase in income also increases the demand for money, for liquidity. If there are more things to buy, you want to hold more cash to be able to buy them. And if people want to hold more of their wealth in cash, then investors are going to have to pay people more to persuade them to put their money into illiquid bonds. As the interest rate rises, investment falls. So we see a short-run crowding out. The increase in output is less than the simple Keynesian cross model would have predicted. It's only this amount, 3, instead of the full amount, 1, because that model doesn't include changes in the interest rate. In the same way that an increase in spending will increase the size of the economy in this model, a cut in taxes will also shift the IS curve right, causing interest rates to go up and the economy to grow. The difference, see if I can get to that bit. There we go. The difference is the magnitude of the effect. A change in taxes of this amount, delta t, causes the IS curve to shift right by delta t times this. This is the tax multiplier. Now, some people ask at this point, why does the IS curve shift right when there's a negative sign here? Well, that's because a tax cut is actually makes delta t negative. Taxes go down. So that negative times this negative means that for a tax reduction, this entire term is a positive, which is why IS shifts right. Now, the distance of the shift is almost the same as in the case of government spending increase, a government spending increase. But for an increase in government spending, the fiscal multiplier is 1 over 1 minus MPC times the change in government spending. Here, it's, forgetting about the negative for the moment, MPC over 1 minus MPC. The marginal propensity to consume is less than 1, which makes the effect slightly smaller. Here's the intuition. Every dollar of government spending increase does increase someone's income by a full dollar. Now that person will go on to spend only some fraction of it. Let's say if the MPC was 0.8, they would only spend 80 cents of that dollar. But the first effect is 1 full dollar of additional spending. But if it's a tax cut, the first effect is the person who receives the tax cut spends 0.8 or 80 cents of it, assuming the MPC was 0.8 in that example. So in the very first round, there's a difference because with a tax cut, some of that tax cut is never spent. It goes into savings right away. So that's why the net effect of, in this model, a tax cut is slightly smaller than the effect of an equivalent increase in government spending. All right, now let's look at a change in monetary policy. If the money supply increases, that shifts the LM curve right. Here it says down. They're trying to be consistent in how some of the graphs are constructed, but it's not a significant. It's a difference in style, nothing else. So the money supply increases. This causes the interest rate to fall. People will use some of this newly created money to buy things. So the economy will grow. But they'll also save some of it. And as the supply of savings increases, the price of savings, the interest rate, falls. In terms of bonds, the increase in the demand for bonds would drive up the price of bonds, which in turn would cause the interest rate to fall since interest rates are inversely related to bond prices. So if everyone wanted to put their money in bonds, you'd be able to sell all the bonds you would need to finance your investment project while paying a lower interest rate. That's how it works. So interest rate falls. That causes investment spending to rise, which causes output to go up. But the increase in income would also cause an increase in the demand for money, for liquidity. If the economy is bigger, there are more things to buy. You would want to hold more cash to buy them. Um, that will tend to drive the interest rate up, but it doesn't increase it all the way back to its original value. It just makes the net reduction somewhat less. Okay, the policy changes we've looked at so far are for an exogenous change in one policy, holding all the other variables constant. But in reality, monetary and fiscal policy don't exist in isolation. They interact. The Fed, on the one hand, and whoever is in charge of fiscal decisions, President, Congress, on the other hand, they each have policy goals. And these policy goals may not be compatible. So the ultimate effect of a fiscal policy change, for example, would depend on how the Fed would react to that change. Let's look at an example. If I can make the page move. Okay. Let's assume that the fiscal policy change is an increase in government spending. What are the Fed's options to respond? Well, the Fed can do three things. It can hold the money supply constant, it can hold the interest rate constant, or it can hold output constant. Each one of these has a different net effect interacting with the original fiscal policy change. Let's look at them one at a time. If the Fed decides to hold the money supply constant, there we go. Well, we're shifting from IS1 to IS2, from this equilibrium to this equilibrium. But keeping the money supply constant is essentially the Fed choosing to do nothing. So the LM curve doesn't shift, and we remain here. The economy is larger, and interest rates are higher. Now, what happens if the Fed decides to hold the interest rate constant? Okay, so we start at this equilibrium. The IS curve shifts right. We move to this equilibrium. The economy has grown to Y2. Interest rate has gone up to R2. Well, if the Fed wants to push the interest rate back down to R1, they would increase the money supply. So we would move to the intersection of IS2 and LM2 here. This reduction in the interest rate is also going to reduce savings, because if the interest rate's lower, the cost of liquidity, the cost of holding cash goes down. Well, if savings fall, that's the same as spending increasing. And if the interest rate is lower, that's also going to increase investment. So the economy would grow even more to this point, Y3, than it would have from the fiscal policy change by itself. Now, what if the Fed wanted to keep output constant? Well, the first shift from IS1 to IS2 would increase output from Y1 to Y2 and increase the interest rate from R1 to R2. To push the economy, the output of the economy back down to Y1, the Fed could contract the money supply, which would shift the LM curve left. We'd be at this equilibrium. uh, that would cause the interest rate to go up even more from R2 to R3. Higher interest rate means more savings or lower spending, which causes the economy to contract. And also higher interest rates uh, would cause a reduction in investment spending. Both of them would make the economy shrink from Y2 back to Y1. All right, now we can look at using the ISLM model to examine the effects of exogenous economic shocks. In economic terms, a shock is something that suddenly pushes a market off equilibrium. It's assumed to be instantaneous and a one-time event. Examples of shocks to the goods market that would shift the IS curve. The 9/11 terrorist attacks, a hurricane. That's more of a regional effect, but in a smaller country, it could very easily have a large impact. The 1973 Arab oil embargo, a policy change to suddenly and drastically reduce the world oil supply. Okay. Uh, you can also have shocks to the money markets. Um, Shocks to the financial side of the economy can cause the LM curve to shift. Anything that causes a sudden change in the demand for money, for liquidity, will shift the LM curve. Good example of that, the 2001 recession. There were three major shocks, pretty much all at the same time, that triggered this recession. First, the dot-com bubble burst. Um, the stock market, it was in boom times during the 90s. You can see that through here. But then in the spring of 2000, uh, the market crashed. We call that the bursting of the dot-com bubble. Now, what was the dot-com bubble? Um, I have not lived my whole life with the internet. You have. So I think to some extent, people of your age take it for granted that we've always understood how it would affect our lives, how it would affect business. That's not true. Um, when the internet started to really get big so that ordinary people began to interact with it in the early 90s, everyone knew that it would radically change how we conducted business. But at first, nobody really knew how it would affect business. So there were a huge number of new companies that were started to try and take advantage of this new technology. These are called the dot-coms, because frequently in the name of the corporation was something .com. Um, and everyone knew that the internet was going to be very important. So prices of these stocks skyrocketed. Um, Tech stocks tended to be traded on the NASDAQ exchange, not the New York Stock Exchange. You can see here, this is the NASDAQ index. But by the late 90s, people started to figure out what the internet was good for and what it was not good for. And people started to figure out that most of these dot-coms that were created were all hype and that they really were not going to work out. An example that I use in principles class, and this is just made up, but early on someone might have started shoelaces.com. We're going to make $1 billion selling shoelaces over the internet. Well, today we know the things intuitively that the internet's not good for. Shoelaces.com is a stupid idea. But when the internet was just starting out, people didn't know that shoelaces.com was a stupid idea. But when people started to figure out how the internet could really be used in practical terms for business, it's like people figured out all of a sudden that the emperor had no clothes. And everybody pretty much at once figured out, whoops, and dumped their .com stocks, prices crashed. But this fall in stock prices reduced the wealth of millions of U.S. consumers who had money in the stock market. Their wealth was reduced. They responded by reducing consumption, spending. This can be seen as a shift to the left in the IS curve. Now, the second shock that contributed to the recession of 2001, September 11th, the terrorist attacks on New York and D.C. This also caused the stock market to crash. This was the largest one-week decline in stock prices since the Great Depression. People were very uncertain about the future. There was a lot of fear. Well, greater uncertainty can also reduce the willingness of households and businesses to spend. If you're not sure what's going to happen and you're worried, you might want to save a little more just in case. This also can be seen as a shift left in the IS curve. The third shock. There were a number of accounting scandals at very prominent companies that came to light pretty much at the same time. Enron, WorldCom. If you're studying finance, you've probably heard these names. This caused a further reduction in stock prices. Individuals' wealth, household wealth went down. This caused a further shift left of the IS curve. So, all these three things together produced a fairly severe recession. In response to the slowdown, both fiscal and monetary policy were used to try to counteract the effect. The Fed increased the money supply, which shifts the LM curve to the right. That caused interest rates to fall. Congress passed fairly aggressive tax cuts. Also, an emergency spending bill to start rebuilding New York. Another spending bill to bail out the airline industry because, again, you weren't really around at the time. Because the attacks used commercial aircraft, the first thing that happened was all non-military aircraft over the entire United States were grounded. There were no flights. And even after they were allowed to fly again, people were frankly afraid of getting on an airplane. So the airline industry, all the major airlines, would have gone bust if the government hadn't intervened. All of these things shifted the IS curve right. Now, there was also a major war in response to 9/11. The United States invaded Afghanistan. That was not done for economic reasons, but wars do involve significant government spending. So even though it was for a different purpose, that also shifted the IS curve right. You can see the result of the change in monetary policy here. Um, Shifting the LM curve right caused the interest rate to fall. Another example we can use the ISLM model to think about is the Great Depression of the 1930s. Starting in the early 1930s, the United States and, well, really the entire world experienced an extremely severe economic contraction. Economists have been studying the Great Depression for almost 100 years now, in part because it's a puzzle, and economists love puzzles. But also, we study it to make sure we understand how to prevent it from happening again. We have several theories about what caused the Great Depression. They agree in some ways and they disagree in others. And it's hard to disprove theories in macro, so maybe there's a little truth in all of them to some extent. This graph on the screen is from table 12 on page 352 in your textbook. Look at the magnitude of the fall in output, and in particular the corresponding unemployment rate. Here, 1933, the unemployment rate was over 25%. That's difficult to imagine how bad the suffering was. So, what caused it? The first theory about what caused the Great Depression is the sort of traditional Keynesian perspective. The ISLM model teaches that a leftward shift in the IS curve reduces income and interest rates. Since nominal rates fell during the Great Depression, a negative shock to the IS curve is one possible explanation. This is frequently called the spending hypothesis. Now, I should note, you may have heard this term, animal spirits. This is what Keynesian economists call sudden changes in consumer spending, consumption in our model. It essentially means an irrational panic or herd instinct that really doesn't have a practical real-world cause. Now, there were large reductions in consumption and investment spending between 1929 and 1933. What caused it? Consumption might have fallen because of a decreased consumer confidence following the stock market crash of '29. Here, I'm using the term correction in the stock market sense. It means when prices are perceived to have been too high and come back down to a more normal level. Another possibility, housing investment fell, maybe because of overbuilding in the 1920s. Also, in the early years of the Great Depression, there were many bank failures. That could have contributed to falls in investment. Banks closed, hard to get a loan. And there were tax increases in 1932. All of these may have decreased consumption. Now, The second main theory about what caused the Great Depression is the monetary hypothesis, that it was a problem in the liquidity money markets. A particularly striking feature of the Depression era data is the very large fall in the money supply. It contracted by a little more than 25%, the M1, between 1929 and 1933. A monetary contraction shows up in the ISLM model as a leftward shift in the LM curve. That would reduce output, but there are two problems with this version of the monetary hypothesis. First, prices also fell dramatically over this time period. So real money balances actually increased a bit between 29 and 31, although they did fall some between 31 and 33. And the second problem is, from the perspective of the ISLM model, is that a shift left of the LM curve should cause interest rates to go up, not down. And down is what we saw in the Great Depression. Now, there's a variation of the monetary hypothesis that says even if money and prices fell, so that real money balances basically didn't change, and therefore the LM curve didn't shift significantly, the deflation, the falling prices, might itself have played a role. Let's look at that. The great Irving Fisher argued at the time, at the beginning of the Great Depression, that we should just allow prices to fall. The economy would adjust, it would reach equilibrium again, and all would be fine. Falling prices might also increase output due to, it's called a Pigou effect. Reduction in the price level increases the value of real wealth. So consumption would go up, it would shift the IS curve to the right. There are other ways to look at it that are a little more consistent with this second version of the monetary hypothesis, which suggests that deflation itself can reduce output. Consider first the effect of an unexpected deflation. This would cause a redistribution. We saw this in Chapter 5, how predicting the inflation rate incorrectly will cause a redistribution of wealth between borrowers and lenders. In real terms, if it's unexpected deflation, it would shift wealth from borrowers to lenders, because the borrowers would have to repay their loans in dollars that can buy more than they were planning on. Now, let's suppose that creditors and debtors also collectively differ, systematically differ, in their marginal propensities to consume. It's not unreasonable to think that debtors, people have to borrow money, might have a higher propensity to consume than creditors. Creditors tend to be wealthier. Think of it this way. You give a poor person $1. They're probably going to consume most of it and save very little. You give Bill Gates $1. It's not going to change. He's not going to spend most of that right away. So redistributing wealth from debtors to creditors would reduce aggregate spending, which would shift the IS curve left. This is known as debt deflation theory. Now, let's look at the effect of expected deflation. We know from the Fisher equation that the nominal interest rate equals the real rate plus expected inflation. But what if it's expected deflation? Let's assume that the real interest rate is 5% and the expected inflation rate is negative 7%. Well, then the nominal rate would be 5% minus 7% or negative 2% nominal interest rate. That's the same as saying, give me $100 today, I'll borrow it from you, and in a year, I'll give you $98. But what's the return on holding cash of not lending at all? Well, that's, I'll keep my $100, won't lend it to anybody. I'll just put it in a jar. And a year from now, I'll have $100. Well, that's a better deal. Therefore, no one will ever lend at a nominal rate less than 0%. So the nominal rate can never be negative. This is called the zero lower bound problem. Now, just between you and me, don't tell anybody I told you. Even though this is what the textbook says, there actually are circumstances where people can rationally lend at a negative interest rate. That gets into behavioral econ and things for another day. Okay, so how would expected deflation work? Assume you wanted to buy a car sometime soon. Wasn't an emergency, you don't need it today, but you want to buy a car. And you have a friend who works at the car dealership who tells you that there's going to be a big unannounced sale next week. Would you buy your car today? I'll wait while you think about it. I'm pretty sure the answer is no. You'd wait for the sale. Get the same car, lower price, what's not to like? Whoops. There we go. So that's for buying a car, but what if you knew that prices in general would be much lower tomorrow than they are today? You would postpone buying things. That is, you would reduce your spending today. And if everyone stopped spending at the same time, what would happen to prices? Obviously, prices would fall. But if prices are falling, people will cut spending even more. This creates a feedback loop where the more prices fall, the less people spend. Therefore, prices fall more, so people spend less. It's a self-reinforcing cycle. It's like being on the top of a mountain and you just move a little bit of snow, but that triggers a huge avalanche. This is why central banks generally do not want the inflation rate to be zero. They want a small positive amount of inflation so that if there's some small random shock to the economy, we will not be pushed into deflation, which could trigger a downward spiral. Now, at the start of the Great Depression, the Federal Reserve did contract the money supply. But remember also how banks, through the fractional reserve banking system, also create money. And when banks started failing, shutting down, closing their doors, that also resulted in a reduction of the money supply. So we have well-developed monetary theory now, thanks mostly to the great Milton Friedman. So we do have a better understanding of what to do and maybe more importantly, what not to do. But there are other things that make another Great Depression-like less likely. Um, Federal deposit insurance um, that was enacted in the wake of the bank failures in the 1930s. Uh, Deposits are insured up to fairly high levels. That makes large-scale bank failures very unlikely in the United States, at least. And most countries, advanced countries, have similar systems. There are also what are called automatic stabilizers um, in fiscal policy. These are things that, without passing any new law, that automatically kick in taxes or spending that push the economy in the direction opposite of the economic shock. An example, income taxes. If people's incomes fall, they automatically will pay less in taxes. It's like a tax cut. Unemployment insurance. So, if people become unemployed, it replaces a portion of their income and prevents spending from falling as much as it would otherwise. Now, let's look at the Great Recession of started in 2008. Ben Bernanke was the chair of the Federal Reserve about 3 chairs ago. Before that, he was an economist at Harvard. He was one of the world's leading experts on the economic history of the Great Depression. So we were just amazingly lucky that he was the Fed chair at the start of the Great Recession. Drawing on his knowledge of the Great Depression, he chose to massively increase the money supply. The federal funds rate dropped from a little over 5% down to 0. You can see that here. The M1, starting in 2009-ish, just skyrocketed. There was a sort of a joke. Economists called it the Fed throwing money from helicopters. There was this image of Ben Bernanke in the back of a helicopter with the back door open, shoveling money out as he flew over the country. We'll never know what would have happened if the Fed had not acted so aggressively to increase the money supply, but most economists think it did help soften the blow. That's it for now. Thank you for watching. I'll see you next time.